Three basic ideas that underlie successful investing, which is to look at stocks as businesses and to have the proper attitude toward the market and to operate with a margin of safety. They all come straight from Graham.
The World of Investing, one book that has stood the test of time, is The Intelligent Investor by Benjamin Graham. First published in 1949, the book's principle of value investing, diversification, and discipline have been embraced by investors of all levels. Whether you are a seasoned pro or just starting to dip your toes in the world of investing, there are valuable lessons to be learned from the classic text. Today, we are going to embark to a journey of learning some of the key lessons that we can attain from reading this awesome book. First and foremost, invest in companies, not stock tickers. There's plenty of money to be made in investing, but remember, there's also a lot of money to lose. When it comes to finance, there are amazing stories from gurus like Warren Buffett, who made a ton of money from investing in the right companies. But also, if you go through history, you will notice that plenty of losers are available. Take an example of Sam Bankman-Fried. Lots of investors lost their money in the FTX company scandal. So when investing, always focus on understanding the fundamentals of the companies you invest in. Don't simply buy and sell based on market trends and sentiment. Take the time to research the company's financial health, competitive advantages, and management team. This approach helps you make informed decisions about which companies are worth. Key lesson number 2, invest for the long term. Investing is not about making quick gains. It's about building wealth over time. Adopt a long-term investment strategy and resist the temptation to engage in frequent trading. By holding on to quality investments for long term, you give them a better chance to grow and compound your returns. Statistics show that the less investors touch their portfolios, the higher their average returns tend to be. If you take an example of the S&P 500, it has retained a geometric average of 9.8 per year since 1928 and 2023, outperforming many other asset classes, which shows how the quality of you gaining so much is based on how long you let it to allow it to compound throughout time. Small changes tend to deviate between one stock to another, but if you keep the time, you tend to experience more greater compounding between the different types of stocks. So take your time, allow it to grow, and then you'll experience the benefits of long-term investing. Key lesson number 3, margin of safety is key. A margin of safety refers to buying an investment at a price below its fair value. This provides a cushion against potential losses and protects you from the downside risk. When you invest with a margin of safety, you are being cautious and conservative and ensuring that the odds are in your favor. There's plenty of apps that can really tell you what specific fair value of a company is. You have to do a lot of maths and calculations to just determine what is the fair value of a company and go through the analysis and see how best the company is performing throughout times, and then determine the fair value that you can buy a company. Allow the company to be within the fair value. Once it's within the fair value, then you can be able to buy and purchase at that time and allow it to grow, because it will reach a time where it will be at a higher level, and from there you'll be able to experience that profit that you've gained through you investing. Remember, investing is also the same as a business. You have to gain profit out of it. So you just don't need to buy it. Since you're looking at Google, for example, it's trading at $300, right? And you're buying, and maybe the fair value of the company is $100. So when the company go down to around 200, you've experienced a loss from there. But if you look at it specifically and you buy it at $120 and then it goes up to 300, you've gained a profit of about 180 from that. So always buy a company with a margin of safety. It's very key. Look at the fair value, then make a bigger decision from that. Diversification is important. Why do you look at diversification? Diversifying your portfolio basically means spreading your investment across different asset classes, such as stocks, bonds, and real estate, and sectors such as technology, healthcare, and energy. Just instead of putting all your eggs in one basket. By diversifying, you reduce your overall investment risk. If one sector or asset classes underperforms, the other may still perform well, mitigating potential losses. A diversified portfolio can help to cushion the blow of one particular investment doesn't perform as well as expected. We'll take an example of different companies. Let's look at the current situation right now with the AI booming and everything. Some people might think, you know what, I need to invest in more AI company. You decide to take all the small companies or the big companies that are currently dealing with AI. And a few years later, probably there's something that happens in the market and you realize that real estate is growing bigger and bigger every single day. And then you start pushing, now moving, and then the AI is not performing better than you would expect it to perform. And that becomes a critical issue. But if you are a seasoned investor or you're just an investor starting, the best advice I will ever give you is you need to invest in diversified portfolio. Another key lesson that we can learn from the intelligent investor is don't try to time the market. Timing the market means trying to predict the perfect moment to buy or sell investments based on a short-term market trends. Trying to time the market will always be losing game. So it's best to just avoid playing. Instead, you should focus on investing into quality companies and funds with the intent to hold long-term. By staying invested, you can benefit from the compounding growth of your investment over time. Another key lesson that we can learn is ignore the market noise. So when you think about it, there's so much advice that we get from the media. The financial media and analysts often create noise that can distract investors from their long-term investment goals. It's important to learn to filter out the noise and negative headlines. Stick to your investment strategy and remain focused on the long-term outlook for your investment. An important aspect of being an intelligent investor is conducting thorough research and analysis before making an investment decision. This means looking beyond market trends and popular opinion and instead focusing on underlying financial health of the company. This is so much key, especially now. The age of technology and the media, we got TikTok, Facebook, Instagram, Threads, Twitter, and all that. Imagine this is a book that was written in 1949, where we didn't have this media. This lesson is actually more important now that we have a lot of information from the internet. You need to filter through the internet. You need to take your time and analyze the company, analyze everything. And if you cannot be able to analyze a company and you don't want to invest in individual stock, you can pick as easy as ETFs. There are plenty of ETFs provided by different companies like Vanguard and BlackRock ETFs. Pick one of them and decide to go. You have S&P 500, which monitors the biggest 500 companies in the US. It's up to you to make a decision from this. You need to learn to analyze everything. A good investor always look at the financial health of the company, the competitive advantages, and the management. Lesson number 7 that we can learn from intelligent investor is be patient. Successful investing requires patience and discipline. Avoid making impulsive investment decisions based on hype or fear, and give your investment time to perform. Remember that investing is a long-term commitment and short-term market fluctuations shouldn't dictate your actions. Very key and important, and it links back to our lesson number 7, where we clearly state that know the market noise. You need to be patient, allow time for compounding to happen, and experience that through the season. You will always experience up and down with investing. Lesson number 8, emotions will cloud your judgment. These always attribute to the being patient part, where we need to not act on impulsive investment. Emotions such as fear or greed can cloud your judgment as an investor. Fear may lead to panic selling during the market downturns. Greed may push you to chase speculative investments without prior due diligence. Develop the ability to make rational investment decisions based on principles and objective analysis, rather than being swayed by temporary emotions. Lesson number 9, understand your circle of competence. Invest in companies and industries that you understand well. This knowledge gives you an advantage and builds confidence in your investment. Take time to research and educate yourself before making any decision. Remember, confidence in investments comes from knowledge and understanding. And having confidence in your investment is the only way you will have the emotional intelligence to hold during the periods of extreme volatility. Finally, continuously learn and improve. The world of investing is ever evolving. The best investors are lifelong learners who continuously seek to improve their skills and knowledge. Stay open to new ideas, strategies, and market trends. Read books, follow reputable financial websites, and consider attending investment seminars or webinars to expand your understanding of the investment landscape. Subscribe and like.